Sir, we are live.
ಎಲ್ರಿಗೂ ನಮಸ್ಕಾರ. Hearty welcome to Jnanarjane Empowering Excellence. Friends, we are stepped into day 3 of 4 days wealth management workshop. Today we are going to understand the treasury and NRI investment in India. In addition to that, the basic qualities required to become a wealth manager. To enlighten us today, we have three eminent speakers. Mr. Sujoydas is an expert and he is the trainer for wealth manager. And Mr. Dilip Balakrishnan and Mr. Vikram Sengupta. All three are expert in wealth management. We heard Vikram and Dilip earlier also. So they enriched us in all the topics they spoke to us. And today, once again, a much more interesting session, treasury and NRI investments and the qualities or the basic requirement to become a good or a successful wealth manager. With that note, hearty welcome to Dilip Balakrishnan. Hearty welcome, Dilip.
Thank you, sir. Thank you.
Hearty welcome to Sujoydas on behalf of Bangalore branch and on behalf of all the participants here. Hearty welcome to Sujoydas. Hearty welcome.
Thank you very much.
Hearty
Delighted
welcome
to be here.
Yeah, on behalf of Bangalore branch and on behalf of all the participants here, hearty welcome to Vikram Sengupta. Hearty welcome, Vikram. On behalf of Bangalore branch and on behalf of all the participants here, hearty welcome to Dilip Balakrishnan once again. And participants, you are the reason this program is happening. Workshop is organized by us. Hearty welcome to each one of you. I'm sure all of you enjoyed or learned a lot in the last 2 days of learning. Today is the third day, much more interesting one. And hearty welcome to each one of you. Other faculties are Kushbu Shetia. Hearty welcome, ma'am.
Thank you. Thank you so much, sir.
Yes. Then our MC colleague Divya. Hearty welcome, Divya. Friends, with that note, I'll just take a minute to explain. Tomorrow we have arranged a workshop on standards on auditing. It is a 4 days workshop starting from tomorrow, 1st June to 4th June. Again, another workshop on Ind AS starting from 6th June to 9th June. Again, it is a 4 days workshop. Then very interesting workshop on succession planning. That is from 10th, 11th and 12th. 3 days workshop from 10th June. And another important workshop of 6 days is international taxation. That is starting from 17th June to 26th June. So these are all the 4 workshops lined for the month of June. I request each one of you look into bangalore.ici.org and register for those workshops. Workshop accounting stand Ind AS and standards on auditing is free of charges. It is learning sessions. I request those who are into audit and assurance practice must attend those workshops. This is need of the hour. I request all of you register and inform your friends and colleagues about those workshops. Another lucrative and very interesting workshop is succession planning. I request you to register that too. With that note, once again, hearty welcome to each one of you friends. Over to Divya.
Thank you so much, Chairman. A very pleasant good evening to all the dignitaries and to all the participants. I would like to give brief introduction about our today's speakers. Vikram Sengupta is associated with the Indian capital market for last 18 years, having worked in some global investments bank like Lehman Brothers and Nomura International PLC. His educational qualifications are Masters in Economics and MBA from IIM Calcutta. With this brief introduction, I welcome you for today's program, sir. Mr. Dilip Balakrishnan is pioneer in estate planning services with an experience of more than 20 years in the wealth management industry. He has worked in MNC banks like Deutsche Bank, HSBC, Standard Chartered Bank, and EFG Swiss Bank, and was instrumental in drafting more than 5,000 wills and over 3,000 private trusts for HNI families. By qualification, He is Company Secretary and graduated law. With this brief introduction, I welcome you also for today's program, sir. We have Kushbu Setia with us. She has in-depth banking experience and is currently a relationship manager at Startmore Wealth. Very hearty welcome to you also, ma'am, on behalf of Bangalore branch. We also have Mr. Sujoydas with us. He is a founder member of OAWA, which is an online academy for wealth advisors. His strong credentials include being the former head of fixed income investment at Invesco Asset Management. Mr. Das has an enriching experience of over 25 years in fixed income and currency markets in esteemed organizations like DSP Merrill Link Mutual Fund and Bharati AXA Mutual Fund. He was instrumental in managing funds for both domestic and offshore investors. His education qualifications include bachelor degree in economics and MBA in finance. With this brief introduction, I welcome you also for today's program, sir. I request Chairman to take.
Thank you, Divya. Our welcome to Anindita Mandal, another faculty of the team. And with that note, I request Sujoydas to take over. Please go ahead, Sujoydas.
All right. So thank you very much. So it's a very, it's an honor to be here amongst all of you. I understand it's an online environment, so I'll try my best to ensure that we have a very engaging session. Please feel free to ask questions at any point in time. The subject of my presentation today is all about wealth management. My credentials are largely, I have been a fund manager for the last 25 years, and we are in the process of setting up a wealth management academy. So we would be keeping our discussions largely around what does wealth managers, particularly the credentials that are needed to become a wealth manager, why is it a promising career in India at this point in time, how lucrative could be the career, and so on and so forth, and what are the basic qualities that one needs to imbibe in order to become a wealth manager. But please feel free to stop me anywhere to ask any questions, please. Let me just load a presentation first. Give me a second. Can somebody please confirm that whether you're able to see the presentation on the screen?
Yes, we can see it.
Yeah, perfect. Thanks.
Well, sir, we can see.
All right. Okay, so let's get going. Why wealth management? So I understand that all of you in the group today are chartered accountants, and there can't be any more a better qualified person other than a chartered accountant for a program like wealth management in India. And for that matter, wealth management as a course anywhere in the globe. I think chartered accountants are highly suited to become a wealth manager themselves at some point in time. Why does it make sense in it? Okay. Now, what is the landscape and what is the opportunity? There is a dream by the central government that India, from being a $2.5 trillion economy, is striding towards to become a $5 trillion economy by 2025. Only time will tell us that whether we are able to reach the $5 trillion mark. However, there are several policies, measures by both the central government, the state governments, and the other regulatory authorities, including Reserve Bank of India, which are tuned towards ensuring that there is a healthy level of growth which is there within the system. And if that growth continues, we possibly will reach the $5 trillion mark sooner than later. Now, what does it mean that for an economy like India, and why is it such an important milestone to look forward to? Because if the economy is growing, economy is constituted of everyone, right? It includes the government, it includes the institutions, the corporates, and includes individuals, people like you and me. Now, it is unlikely because it's the sum of the parts, right? So if the economy reaches to become a $5 trillion mark, obviously that what it means is that for everybody of us, whether the institutions, corporates, individuals, there has been expansion of their personal balance sheet. And that's so very crucial. The second thing that's important to keep in mind is that with rapid economic growth, what it means is what I was mentioning is that there is going to be rise of income and wealth. Either the overall income of every person keeps going up, and that's I think a survey that we keep tracking every year to see that, oh, what's been the salary growth in the IT sector this year, what has been the salary growth in the banking and financial services industry this year, and so on. So there is income growth which is happening and which is bound to happen in case the overall GDP is growing, and they're all linked to each other. It is unlikely that the economy will keep expanding when the income of the people are not expanding. It is highly correlated to each other. And if there is rise of income, obviously that entire money that you are getting as salary and income will not be spent, right? There would be some portion which will be saved. There will be something surplus left after consumption, which is quite natural. And that savings either gets saved in the form of savings, or it gets saved in the form of an asset. You buy into an asset or you invest into an asset. So your wealth, because there are times when the asset prices keep going higher, and that is when your wealth also keeps growing higher. That is the beauty of it. And we are going to discuss more about it as we go ahead. Now, what is the landscape looking like? So as of now, there are 40,000 active wealth advisors servicing the top 3% of the population of the country. And these are the HNIs, the ultra HNIs, and so on and so forth, right? But what we have observed, and it's there in the Credit Suisse Global Wealth Report, it's been coming out every year on year, but the last one of October 2020 suggests that this expansion of wealth is just not happening for the top 3% of the population. It has started happening for the next bracket of the population as well. And what is this next bracket of population? It is the middle income group. The middle income group has started to experience expansion of income and wealth at a very steady pace. And this number, which is 25% of the population, which is eligible to be calling themselves wealthy enough to seek the services of a wealth manager, used to be under 10% about 4 years back. In the last 4 years, there has been a steady growth in the overall income and wealth, and this number has steadily been growing. With the advent of new technology, new kinds of companies, new technological, supported companies, there has been expansion of wealth across the strata of population. But 40,000 active wealth advisors, is it sufficient to meet the needs of the next 25% of the population? Answer is obviously it is left to anybody's imagination, but it is unlikely that they will meet the demands for the next 25% of the population. And this number is continuously expanding. What it suggests is that simple mathematics says that if 3% of the population is being met right now, is being serviced right now, and if there is demand coming in for the next 25% of the population, we require at least 8 times more number of current advisors. So we need, few lakhs of additional wealth advisors in our country. Is it going to happen like a magic? So there's no. We as an economy, we as a country have to prepare ourselves for that, meeting that demand. So the demand will get created. Now it is up to us to figure out whether we are able to meet that demand by preparing ourselves, preparing each one of us. And this is what we mean by talking about financial literacy. We as tax advisors, we as chartered accountants may possibly take one step forward, because the best part is that all of you know the clients. You know their pain points, you know their requirements. Okay, so we possibly will be in the best position to be suited, because ultimately it is somebody who prepares oneself for this role. It could be you, it could be somebody else, but clearly since there is a demand which is getting created and which has got created, obviously there is going to be a supply which is going to meet that demand at some point in time. All right, let's move ahead. But why now in India? Yeah. The wealth bracket in India has been growing rapidly. So what was 40,000 wealth advisors meeting the needs of 3% of the population was less than 1% about 3 years back. What was 25% of the population right now, the second tier, was less than 8% about 4 years back. So there is a rapid growth which is happening. We may all sit together and keep discussing about the spread of the virus and thinking that how dull the economy has been, how lackluster the growth has been. But we all know that asset prices in some places, some few assets have actually been appreciating. And if asset prices start appreciating, all the investors who have investments into those assets, their wealth is also expanding. And if their wealth is expanding, obviously their needs are also need to be met by someone. They need to have the services of a wealth advisor who would cater to this requirement. Whether it's the Indian stock market which is going up, or whether the prices of gold which is going up, or whether the prices of international equities which is going up, or maybe real estate or something else. Obviously, if investors have investments in assets, and if there is asset price appreciation, which is bound to happen in an expanding economy like India, and best part is that asset prices are not just determined, by what is happening within the economy. Because Indian, for example, let's give ourselves an example of Indian equities. Is Indian equities only invested by Indian investors? The answer is no. Indian equities has demand from Indian investors for sure, but it has demand from foreign investors as well. So it doesn't really matter whether that asset is from a particular location. As long as there are investor interest, whether the investor interest comes in from any part of the globe, there is going to be an appreciation. And obviously it is going to be the price appreciation or whether the prices move lower is going to be determined by what's happening in terms of the investor behavior for each of these locations. There could be an investor who is coming in from an US market. There could be an investor who is coming in from an European market who expand into Indian equities. And since they're investing, the prices of these asset prices will start to go up because, simple laws of economics says that prices go up when there is higher demand. So if the demand for any asset goes higher, then obviously the prices of that asset has to go higher. And this is where the role of a wealth advisor comes in, importantly, is to figure out in which asset classes there is going to be higher demand and to keep reorganizing and your client's portfolio according to those, requirements or those forecasting tools. Now, how large is the market? If we have to put a number, our sense is that there is going to be a 6 crore urban adult population which is going underserviced at this point. And that is the target market that potentially India needs to address very shortly. So we don't know how soon, but it has to happen as soon as it can, right? That is the space that one is talking about. Moving on, how should one prepare, right? A one-time activity to whether you just prepare and then you forget about it. Is it a one-time kind of course that you enroll into, or is it a series of course that you enroll yourself in? How should one prepare oneself? Yes. What is important is that if you are, so there is a difference between balance sheet management and wealth management. Balance sheet management is largely about assets and liabilities, taxes, inflows and outflows, remittances and expenses, and so on. Wealth is primarily to reach the financial goals. There would be, every individual would have certain goals, right? Like financial goals, that you know that there is some expenditure coming up at some point in time. There is one expenditure which always comes up in everybody's life, is your retirement pool of money. Everybody is going to retire at some point in time in their life. Okay, some point in time. One needs to prepare for that financial goal. Nobody, you can't be waking up at the age of 50 and saying that, oh, I want to retire at 58 and 60. What do I do now? Generally, this is a subject which is often ignored. What we feel is that we generally become super busy in our career, in our business, that we are only interested in running the business. Is absolutely perfect thing to do. But at the same time, we should also, it deserves merit to think about stuff from a financial goal preparedness perspective. That could be, the normal stuff that we always think about is marriage, education, house renovation, retirement, so on and so forth, old age expenses, and so on. So, what are we telling to everybody? We are telling that first and foremost, as an individual, we need to get ourselves geared to get into this industry. It's an industry in itself. It is all about understanding asset price behavior. It is all about risk profiling. It's all about preparing oneself for getting into the markets, for that matter. All of these terms may appear big, but in reality, they're actually very simple terms to actually pick up. It is sometimes, it is to appear complex than it is in reality. It is. It's a very, if we apply our mind in a very methodical manner, most of the behaviors of the asset prices, there is sometimes it follows few patterns. And this is where it is important as a wealth advisor. We try to, whether you as a wealth advisor or we as trainers of wealth advisors, whether we'll be 100% correct, it's never going to be the case. But as long as you are in a position to create a basket of portfolio wherein there are assets of various kinds that the investor basket, I think that investment book is going to do wonders for them, because to create, so there are certain merits of the kind of portfolio that one needs to prepare, and we are possibly will discuss more about that as we go along and depending upon the questions that we receive. But first and foremost, it's important that one enrolls into an intensive industry relevant wealth advisory course. One needs to go to the depth of it. We have to pick up the AB wealth advisory. The concepts, to define wealth advisory or wealth advisory management is not a new concept. This is not a new science. However, it could be new for some section of the population. The best of this, that your client will need the services of a wealth advisor throughout his life. It is not a one-time activity. It is not that in 2000 you advise about some advisory needs and get it. It's not going to happen that way. You continuously keep the requirements or the services for the advisor, particularly so because in the assets which you would have recommended that they would be some other assets in which you would have invested your client's money, and each of these will be behaving differently. So you may have invested it thinking that, so I'm getting a message that audio is not proper.
Sujay, your voice is cracking a bit.
I hope it is better now. Okay. So it is important that you keep studying the markets, you keep coming back to your client's portfolio. So it is a continuous process. One needs to go into the basic ABCs of this entire process, keep oneself updated, and it's very exciting. It's very exciting because the more you get into it, the more we will learn about it. It's all about learning a new branch, new science, and it will help you to keep all your senses open to new ideas, thoughts, give you opportunities to meet different clients, and so on and so forth. What is an ideal course? So what are the few things that one needs to learn and once prepare from a theory perspective? Practical, you will turn around and teach us yeah. Is it any better now?
It's slightly better.
Okay.
So your voice at times is becoming mute, I think.
Is it?
No, it's fine. Please
Now it's
continue.
fine. Thanks. Okay. So what's an ideal course in brief? So there are a few things which might be completely new for few of us, few things you might be completely aware of. So the few financial and economic concepts which are very important to pick up in case you would like to become a noteworthy wealth advisor. So that's the word we keep using. If you would like to be noteworthy, you want to be relevant, then few concepts around finance, few important concepts around economics, regulations, right? Behavioral economics, and portfolio management, right? So these are the 5 key, course structure that one needs to go through in order to prepare oneself for a career in the field of wealth advisory. First one is finance, figuring out what finance is all about, right? What to invest, where to invest, what point to invest. And finance, we are not talking about just about incomes and taxes, and we are actually talking about financing an asset. Second is economics. Economics is not just about demand and supply. The economics of the price behavior, the economics of asset price movement, whether the random walk here, whether the markets are going to behave in the same manner, with the same set of data points. Not always true, because we may have, out of 5 variables, we may have commonality in 4 variables, but still the behavior of the prices might be different. Why it is happening? The behavioral part of it. A client may behave completely differently under the same circumstances. Let me give you an example. You have a stock price, let's say like a ABC company, right? So let's say an ABC company which was trading at around 100 rupees. And then you had huge amount of demand coming in and your investors were interested to get in. You yourself were also convinced that this is the right asset type to be invested in. And that stock needs to be possibly 5% of the portfolio, right? Then over a period of time, the prices go up and then eventually possibly it comes down. Maybe it touches a level of 80 or 90 rupees at some point in time. You feel that you are convinced that yes, while the prices have come down over a period of time, but the fundamentals of the company suggest that as a client, as an investor, you need to be invested into that product once again. While you had invested at 100 rupees in the past, since it is 80 or 90, it is so much more convincing to be invested in that company once again. But it may quite likely happen that you may recommend investing into that company at 80 or 90 rupees, but the same client who would have bought happily at the rate of 100 rupees might not be convinced even at the price of 80. This is behavioral economics. The behavior of an individual will keep differing based on multiple things. He may be convinced, he may be distracted. Maybe the recent experience of the last few hours might determine his reactions, his thought processes. Maybe you may tell him that, oh, we are investing for a 5-year period, but maybe his experience of the last 1 month has been so poor that he is not convinced to even invest for a long-term period. So there could be multiple things which might be at play. And the probability of him investing into that asset, although you are highly recommending it, might get bleak because there is some experience which is largely playing in his mind and he's not convinced enough. So this is all about behavioral economics, and that's very important subject because that is the time one needs to let off. You need to stop pressing the pedal because the client has really switched off. He's not very convinced, so we need to give time. So trying to figure out how the behavior is of a person when it comes to finance and investments. So there is a separate branch in economics, which is behavioral economics. So this is a very important subject or a branch which one needs to be preparing oneself for. And the last and the most important one is portfolio management. Because ultimately you're not just advising one stock, you're advising stocks, you're advising other assets, mutual funds, you're advising physical assets, you are advising fixed income assets, because interest rates is also a very large determinant about what happens to asset prices in the future. Interest rates can make or break an economy. Interest rates can actually make or break a portfolio as well. So there are several things, and of course, the final one is the currency. We as an economy might be doing too well, but if our currency remains weak, then all the foreign investors who have invested in our country will get worried and they will start redeeming. And if they start redeeming for the entire market, they are also a class of investors. And depending how large they are vis-a-vis the size of the market, if they are less than 5% of the overall size of the market, then possibly you will not be as worried if they're like 25 or 50% of the market. There are few assets classes where the foreign investors are a significant portion of the market, right? And then there are few assets where there are a tiny portion of the market. So what happens to the currency? What happens to the home country of those investors? Like suppose there is some very lucrative investment option available to them in their home country or some other country. It may appear that India is a very promising economy and a very promising market, but we have Thailand or Indonesia in our neighborhood, which is far more promising than India. So maybe if a foreign investor would, pick up that over India. So you may think that, oh, that foreign money is going to come in, but foreign money isn't coming in because there is somebody else who is actually far more attractive than India as an economy or India as a market. So each of these things, form part or determine how the price behavior will be in these assets. And that will constitute the final portfolio of your client. And then there is, as we discussed, there is a correlation, right? The correlation between one asset to the other. So each of these are very important. So what are the broad course outline? A few things, and these 4 things that we have jotted down over here are only few pointers. They are no way indicative of the vast expanse that one needs to go through. But don't be worried about, when I say vast expanse, because there is a method to this madness, and as a concept. Once you get into the grip of it, you would be able to, go through the steps or go through the process quite easily. The first one is asset classes and investment vehicles. One is to asset. So what are the asset classes? Equities, bonds, gold. These are the primarily 3 large asset classes. Then there is cash, there is real estate, and foreign. So these are the broad. And then there are investments happening in art. There are investments happening in other stuff, exotic stuff as well. So broadly, it begins with equity, bonds, cash, and so on and so forth. What are the investment vehicles? If one would like to invest into equity, what are the ways of investment? So that is what we mean by vehicles. Okay. Whether you should invest directly, whether it should be through a mutual fund, whether it should be through the PMS route, all right? Whether if you're investing into real estate, whether it should be directly into real estate, whether you should just buy, or give it out on rent, whether you should do it through a REIT structure, real estate investment trust. Okay, so this is one thing which is part of the course outline. The second one is risk profiling. The person for whom, or the client for whom you're preparing the investment case, profiling that client is important. What makes sense for them? What possibly doesn't make sense for them? If we turn around and say that, insurance makes sense for them. We may turn around and say that, insurance makes sense for them. But the person is so wealthy himself that he has wealth equal to maybe 10 generations. So does he need life insurance? That's a debatable point. Will you be able to sell life insurance to Mukesh Ambani? It's a debatable point, right? So profiling the client according to his attitude towards risk, right? What are the stuffs that makes sense for him is important. What makes sense for a client A might not make sense for another client, which is client B. They might be from the same corporate background, they might be of the same age, but still their family background or something else, some childhood stuff or something, some other maybe health issues. It could be anything. It could be quite complex, and this is where the wealth advisor comes in. Importantly, is figuring out what will make sense and what will not make sense for that client. This is all about risk profiling. There is no science to it, right? There is no science. It is just about the conversation, and this is where a chartered accountant like you comes in very strongly, because you are so close to the client, and profiling the risk of a client would come quite naturally to a person like you. Then how to analyze, right? How to analyze an asset. So, and there are umpteen stories about investors investing into stuff, and then there would be happy experiences, and then there would be not so happy experiences as well, right? There are situations which possibly might unfold in the manner that you are enjoying, and then suddenly something happens, and then the situation actually takes a U-turn, and suddenly there is a big challenge or a big hurdle which is there in front of you. How do you analyze those situations? How should one react when these things happen? And accidents do happen. If you are driving on the road, it is there is a percentage or probability, not a percent. There is a probability that something might not happen in the manner that you had planned initially. But what is important is how you are prepared or how you are reacting when those things happen. Okay? So that comes over a period of time. That comes through experience, maturity. You look around, you read subjects, you get into the depth of it, and then these things will appear, like quite easy, like ABC. The second part of this is risk versus return. And over here, moment we discuss risk versus return, we have seen, students switching off. People say, oh, that's very easy. We know that if you don't take risk, then you don't get a return. That is true. But how do you understand what is risk is important. How to measure risk. First, identifying the risk is important. Then you will figure out the return, because ultimately the return is dependent on the risk. Right? The risk is not dependent on the return. The return that you should expect is dependent on the risk. And so identifying the risk and the magnitude and the probability of the risk occurring at some point in time is the case in point. If you become a master of that, then you become the best wealth manager around the whole globe. Now let me ask you, and maybe once we have the question and answer sessions, we will have more of dialogues, but I don't know whether this format only allows questions through typing or chat boxes, or it allows direct questions. But nevertheless, I would like to plant something in your mind right now, is that when we talk about fixed income, right, we all understand what fixed income is, right? Fixed income is an interest-bearing product. Okay. So if we turn around, we see there are banks of various kinds, right? There are corporates of various kinds. Every corporate will have a credit rating of their own. Credit rating. Every bank will also have a credit rating of their own. There is a State Bank of India, and there is a there is a corporation bank, and then we have the new generation banks as well. So there are banks of various credit quality, and we also had a Yes Bank, right? We also have a Yes Bank. So there are banks of various credit quality. Similarly, there are corporates of various credit quality. We had instances where, and what is a credit quality? So the normal parlance says that, oh, AAA credits are supposed to be the best, because higher the credit quality, lower is their chance of default. And AAA credits are the least possibility of a default. That is absolutely correct. But does it mean that AAA credits don't default? In India, it was true till about 2018. When in September 2018, there was a default of one of the premier, infrastructure, quasi-government infrastructure companies is defaulted. Island FS, all of you might be aware. Few thousand crores of rupees, didn't get repaid. And that downgrade from AAA to D is a credit quality of a defaulted company, happened in a matter of few weeks, in a matter of maybe 3-4 weeks, between September 18 and by mid-October, moved from AAA to D. What prompted this company to get downgraded so quickly? And if it happened, why did it not get noticed? And then we have instances of few other corporates like Diwan House. We have instances of maybe the ADAG group, Anil Dhirubhai Ambani group. These are all AAA examples in India. All of them defaulted sometime in 2018 and 19, and each of them being AAA, moved down from AAA swiftly down to the level of D. Then there are examples in the mutual fund space also, where funds had to be shut down because of some problem or that. So what is risk in the fixed income space? And what is risk in an equity space? And how do you identify that risk? We may say that, oh, since risk versus return, risk is directly proportional to return. If you want higher return, then obviously, you get invested into those asset classes. Suppose, for example, there is a XYZ company whose fixed deposits, corporate fixed deposits for a 5-year period is available at 14%. And then there is another corporate, maybe an HDFC, a 5-year corporate fixed deposit is available at 7.5%. Which one will one choose? And why? Forget 14%. There are two corporates, A and B. There is one available at 7.5, the other one available at 9. Why do you think that the second company is offering 9 and not 7.5? Is the $1 million question. If this question can be answered, then you have identified the risk. Because nobody would like to borrow at a higher cost, right? As a management, as a promoter of a company, who wants to borrow at an expensive rate? No one. Given an option, he would also like to borrow at 7.5, if not lower. He would try to borrow at 7%. But still, he ends up borrowing at 9% because he's unable to borrow at 7.5. Right? And he is compelled to offer that additional 1.5% because there possibly is some additional risk that company. But most often than not, as investors, as your clients, and you will come through this experiences quite often. Possibly you will experience that this kind of experiences you will have more often than any other, is that investors will nudge you to get invested and ask for recommendations for corporates which are delivering higher returns from a fixed income standpoint. But in the fixed income world, higher return is an indicator of higher risk. If a corporate is offering 9% instead of 7.5%, obviously there is a higher risk. Ireland FS, despite being a AAA entity, their borrowing cost was at least 200 basis points higher than any other AAA entity. Same thing held true for ADAG and the other companies as well. And these are just a few examples. There are examples of umpteen other companies which possibly are not AAA, but even AA pluses, which have gone down. So gone down in the credit ratings. So risk and return is a very important tool that one has to continuously understand. And there is no it is neither a rocket science, but it is not something that one can turn around and say that, oh, I understand this subject, because it's a continuously changing subject. The same corporate who is borrowing money at 9.5 today might appear risky to you, but there may be something which turns around, and tomorrow the company may get upgraded and move from whatever AA rating to maybe a AA plus rating, and his borrowing cost comes down from 9% to maybe 8%. That is the opportunity. Trying to identify corporates which are potential upgrades. Same thing holds true for the Indian equities or for any equities. Trying to identify corporates which possibly will see higher demand, maybe from their business model, maybe from some rejig in their overall management structure, maybe some new markets that they're getting in, maybe some new products, maybe some branding. Something is good. Maybe they have been able to, outsmart their competition, their competitors. So identifying those things slightly ahead in time will actually keep you ahead in the race. And the last one is portfolio monitoring, right? As we discussed, like having created the portfolio, it is not the thing that it's like fill it, shut it, forget it. Continuously monitoring the portfolio. Having invested into a AAA credit doesn't mean that it is absolutely risk-free. AAA credits also default. It has happened in India. It has happened in other countries as well. So we, as a wealth advisor, it would be always prudent to keep the eyes and ears open, stay tuned to the market, trying to figuring out the next potential move and keeping your clients ahead in the race. So this is all about wealth management, broad course outline. So what are the merits of a course?
Joy, can I ask a question on the rating on the?
Yes, Dilip, sure.
Okay. See, one thing is that because of the example you gave, a rated company and the paper, it happened like this. I know a couple of companies who say that even if you go for rating, this is what happens. So we are very safe, is what I know in the market. I can't name the companies though. So they are saying that you come to us, we are very good, we are excellent. So I just want to ask, how do I, as an investor, or an advisor, look at, so if people lose faith in the rated papers, options. So can you just help me with this?
No, sure. So, sorry if I got the question correctly, Dilip. So, you are saying that, so since there have been default in rated papers, so there are a few corporates who are highlighting themselves, saying that, please come to us and we are good, but we are not rated. Are they saying that we are not rated?
Yeah, we are not rated. They are saying we can only be as bad, or we are even better. Even a rated paper is like this. So don't. So they are using this. I can tell you the same example in their presentation and say that no, we are not as bad. We are unrated, but we are. So I'm just asking how to counter that kind of a thing as either an advisor or as an investor. How is that? That's my question.
No. So the simple answer to this is that no. So for these kind of people, there is no answer. What it means is that it doesn't mean that if a company which has been rated has defaulted, that means that everybody else who is also rated is going to default. And somebody, and what, so for that, we also need to understand the merits of rating. What is rating? And why does one get themselves? Why did State Bank of India, the largest bank, got themselves rated? Why did Reliance Industries, the largest corporate in India, get rated? There has possibly some merit to it, right? Otherwise, people would have, kept their balance sheet as is. They would have borrowed money without themselves getting themselves rated. Because there is a third party who is looking at your balance sheet and rating you and grading you. Rating is all about grading. That whenever an investor is investing into your debt pool of capital, the comfort that they should be getting, and because there is somebody else who has also looked at their balance sheet. It is not that any investor is going to invest into your company without looking at your balance sheet. Everybody is going to look at your balance sheet. While it is just going to be me or somebody who is an expert in this field of going through balance sheets, going through your balance sheet, right? So like a CRISIL, ICRA, Fitch, or somebody else who is an expert and having rated thousands and thousands of companies over long periods of time, sees your balance sheet and gives using their methodology, is actually giving the stamp of approval, whether you're a AAA, AA, and so on. So it always makes sense to ensure that there is a third eye concept and that there is more than one person who has looked at the balance sheet. So I think there is no, merit in this conversation if there is somebody approaching you saying that, oh, while since rated companies have defaulted, look at us because we are as good and what we are not rated.
Thank you.
So moving ahead, the last one or two slides is that what are the merits? So if you would like to decide upon joining a course at some point in time, what are the few things that one should look for in a program? Number one, the course content needs to be curated by both the industry and academia together. Industry, because it needs to be a practical one, and academia, because it is all about theories and concepts, right? So it has to be a good marriage between both of them. So it's a very blend of the fundamental parts of the academic world, along with the practical part of the real world, which would make the course to be exciting. It's so very important because every course has to have some, not some, it has to have most of the examples from the live markets, right? Live experiences. Obviously, distinguished faculty members, so much more important. And getting to hear what the industry leaders are doing during a certain point in time. So right now, if you get to hear the best of the wealth managers, the best of the fund managers coming and talking about what they're doing with their clients' money in these times of COVID, when interest rates are moving lower, government is borrowing more, and so on and so forth. Still, why is the Indian equity markets going up? When the economy growth is really hammered, people are unable to get vaccine, but still prices are going up. So we know that 80% of India's population or maybe 90% of India's population must be grumbling about what is happening in India, but still the equity prices are going up. Why is that happening? Trying to, look through this noise and trying to figure that out. So somebody who is in the market day in, day out will be able to give you that guiding torch. And obviously the field work and client interaction. All of these, I think our sense is that if these 4 things are part of a course curriculum, you really go through the grind, and it really polishes you to become a really worthwhile wealth advisor. I think that was it. So these are the few slides that we had from a wealth advisory perspective. So maybe I'm going to stop now, and I'm more than happy to address any questions.
Yeah, Sujoy, I wanted to know one thing, that while you mentioned the content in terms of what are the the hard content or the financial content that one needs to master, how important is the interaction part or the soft skills part when it comes to deciding on a course like this? I mean, is that at all a consideration, or is that to be self developed? How do we look at that?
So absolutely. So this needs interaction with human beings, right? So even in this field where we have chartered accountants in this forum, so it needs human interaction. So even for the wealth advisory piece, to become a really smart, noteworthy wealth advisor, one needs to have a real grip around conversation. And it's all about getting the right clients, speaking the right things in front of them, understanding they have behavioral pattern, their risk profile. For that, it needs huge amount of in-depth conversation and multiple rounds of conversation with the client. And all of these things will be possible if one really upskills themselves from a life skill or a soft skill perspective. How to conduct meetings, how to prepare for these meetings, because these meetings are going to be really intensive meetings. Because in front of the client, they will have opinion about few things, because they are a wealthy lot, right? So they are HNIs themselves. They have a decent amount of wealth, and they have amassed that wealth because they are intelligent, they are smart. So when you are getting into a conversation with a client like this, one needs to be potentially one step ahead of them when you're getting into a conversation, right? You want to be a partner with them. So you need to be, and they will only partner with you if they find you to be equal. Because they themselves might be a 5 crore, 10 crore, 20 crore, 50 crore, or whatever wealth bracket guy. They potentially will not give their wealth to somebody whom they don't consider themselves to be equal. And how do they consider themselves that person to be equal? Because depends upon the kind of conversation that one is able to bring forth. What kind of background, what kind of experience that one comes in with, what kind of performance deliveries that they have had in the past. And if for a batch, for somebody it's like a newcomer in this field, then it has to start with a soft skills part. How do you conduct? How do you interact with the client? How do you acquire a new client? How do you manage that new client? And they are very smart cookies, and one needs to be at least few steps ahead. So soft skill plays a very important role. But I didn't cover soft skills particularly for this session because I understand that this August gathering over here, I've been interacting with their clients, and for them, client acquisition would be coming very naturally, and they have their own existing strength of network of clients. So that's particularly one reason that I omitted it for this one. But yes, for a completely newcomer, this is absolutely, if you would like to be industry ready, then it is just not the fundamental skills, it is the emotional quotient also, which plays equally, if not more, significance in this area.
Right, thank you.
That's for the question.
I think do we have any more questions from the panel? Guess not. So do we go ahead with the next presentation, Divya?
Yes, I think you can go ahead, Vikram, and if people still raise questions on the topic, he can, or Shuja can always address it again.
Yes, I'm around. Of
Sure,
course.
sure. I am not enabled for presentation. Just let me see.
You are not yet. Khushbu, do you?
Dilip, can you bring it up?
I don't think even I am.
When I cannot share.
Can you check?
Khushbu, can you put up that presentation on the screen?
Vikram, I'm not getting that option to share.
Oh, now I've been made a presenter. Okay.
Okay.
Just one second. Just 1 second.
This will be on treasury, right?
Right, right. Is it visible now?
Yeah, it is visible. You can
Hmm.
do present. Yeah. Yep,
Okay.
it's there.
So I think by now, most of you would be knowing about us in terms of our profile, and Divya also was kind enough to include that in the opening speech. And so let's straight get into the main presentation. As usual, we will start with a quote, Warren Buffett. Rule number one, never lose money. Rule number two, never forget rule number one. So just on this, taking the essence of this, what I wanted to highlight is that for wealth managers in general, uh, what is the core activity that we are conducting? The core activity that we are conducting is protecting the money and growing it, as we had discussed last time, growing it above inflation rate for all HNIs that are whose money we are managing. Just to re-emphasize few points that we made last week, why is inflation important? Because that is the rate at which the money that we hold in terms of cash is losing its value. So what I can buy with, if I keep a 100 rupee note with me and I keep it in a locker and not do anything with it, and assuming I suddenly find that note again after 10 years, what I could have bought with that 100 rupees on that day when I kept it in the locker, today the number of that things after 10 years that I can buy is far lesser because the price of goods have gone up, but my money it still remain the same at, in this example, rupees 100. So so this activity of generating wealth and at a return at a rate which at least beats inflation, so that our overall net worth or the value of a net worth at least remains same, if not grows, is one of the key activity. The other activity is that, as I had also mentioned this last time, that no investor wants to see a, a red component in their portfolio. Red is when your portfolio is going down. So one of the things that to keep in mind, and this was highlighted by Shujoy also in his earlier presentation, that how do we manage risk such that we don't lose money for our investors over a certain period of time. And in this, it also comes into the play that how are we managing expectations of investors. Just to make this point little clear, assuming I had taken the mandate to manage somebody's wealth, say somebody had given me 10 lakh of rupees to invest in a manner such that it grows in a certain manner, at least, as I said, covering the inflation. Assuming I had used, and I also discussed last time how we do the asset allocation, what principles we use to do asset allocation. Assuming I had used an asset allocation of debt being 50% and equity being 50%. Now, if I had invested 50 rupees in debt and 50 rupees in equity, there can be a potentially can be a situation where the equity market comes off and my 50 goes to say 40 or maybe 38 or 35. What happened last year, as I was giving you this example of last year between March to May. Now, in the life of a wealth manager, you will encounter or you will face this situation many times when asset prices will not move exactly the way you expect, or at times the asset prices may not move in line with what in general consensus expects. And now think that you are sitting in front of a investor. An investor is giving you time for a meeting to discuss his portfolio, and you take a look at his portfolio and you see that the overall portfolio after a year is down, say, 10%. And here you are carrying a mandate to protect his money and to grow at a rate higher than inflation. And trust me, friend, this will be coming to you very often in your life. How you deal with this situation to a large extent will determine how successful you become as a wealth manager. This is where it comes the point of when you had disclosed all the risks when you were creating the portfolio. If I had put this dictum or if I had put this rule on that portfolio saying that, sir, when I'm keeping money in equity, we are not going to take a call on it unless and until we have crossed a 3 to 5 year period, if you remember what I told you. If you this particular aspect was explained clearly to him that why equity as an asset class requires that period of time, how volatility comes in a short run and how volatility gets smoothened out in the long run, trust me, you will have a very fruitful conversation even when you're holding a sub zero portfolio return sheet in your hand. And I have seen and I have met some of the smartest investors who will grant you that leeway that it is in line with how these asset classes behave, because Vikram had already positioned us for this. Remember, you don't need to prepare for the good times, but you certainly need to prepare the client for the bad times. Do not position your proposition that it is a proposition which will hold good at every point of time, because you and I, we both don't know how every point of time will work out. That is exactly the reason why we are putting it out that we need to very clearly state the characteristics of the asset class when we are creating the portfolio. If you remember, I will, and this particular point from Warren Buffett actually is a eye opener for us, because many clients will hold you for this. They will say, Mr. X, we had given you our family money and we had assumed that it was in safe hands. And this is the money that you are dealing with, where the entire family is dependent upon. And here you sit in front of me telling me that my portfolio is down 10%. What do I make out of this? And more often than not, your conversation with one of most of your esteemed clients will be very difficult conversations. How you deal with that conversation will finally determine how successful you are in that wealth management space. And the more transparent you are, the better you will stand a chance in terms of developing your relationship. Shuja mentioned that what are the things that you require in terms of bringing that relationship, and giving it the true in a right shape and form. But the testing period are these times. Today, suppose, and let me give you an example of this. we all know, I mean, most of us would know who are tracking the equity market, that we are kind of near the all-time high in equity market. Just now in the evening, the GDP numbers came out. Bloomberg is celebrating that the number is far better than expected. Chances are there, unless today US market closes in a bad shape, chances are there this rally will extend tomorrow and some more time to come. I don't know. Now, in such a situation where the market is looking so great, imagine me going to an investor and telling them that, guess what, sir, you put your entire family money to me, I will make equity grow because let me show you the chart of last 1 year. Even if I show you the chart last 3 years, you will see that how great equity has been in beating debt hands down. So why are you wasting your money in a debt in a 6-7% return? And he gets equally enthused like you are, and he puts the whole money as per your advice. For 1 year fast forward, few things didn't work out the way you thought, few things didn't work out the way the consensus or everybody thought, and there you are sitting with a negative portfolio in your hand. And trust me, friends, every 1 year is your report card day when you're sitting with the investor. I am just highlighting the difficult phases that you have to encounter. If you can encounter or if you can manage those difficult phases, trust me, you will manage the entire phase of your wealth management career. Now, if I had said that and I'm sitting in that room with the report which is showing a negative figure, imagine what I have to tell him or how I have to explain him why this has happened, given to what I had told him then. Now, go back to that same zone when you were going to him with a proposition and you tell him that we are today at an all-time high. This is how the market moves, sir, and you see those dips that comes in between. So be well prepared that in the period of 3 to 5 years that I'm asking you to hold that equity, there will be a time when you will be encountering probably a negative return, at least on your equity portfolio. But we have you all safeguarded because we have done the asset allocation that your debt portfolio will feed you for the next 3 to 5 years. So even if this situation arises, you don't need to worry because we are in charge of it. That guy and a guy who promised a good return, basis what was happening today, both of them understand the positional difference. And that is what will create how one gets the credibility in his favor and one loses the credibility. So, friends, as long you can stick to the process yourself very honestly, I told you two basic characteristic of a successful wealth manager: honesty and competence. The client has to perceive you as being honest, and the client has to perceive you that you have the competence or the knowledge to do it. I can be very honest, but I don't have the knowledge or the band or the understanding to manage money, so I'm of no use. I have great knowledge, I have great understanding, but I am only thinking about my gain than the clients. I'm not of any use because I'm not honest. As long as you marry this together and you convey it clearly to the client, you will, it might look that I am giving a very, very standardized, a proposition to the client, and I'm not making him as excited as he should be. But always understand the client will always trust you more because he will think that this gentleman is being far more honest than most other advisors I've come across because he is actually giving me a real picture. So this rule, never lose money. It's while the saying comes from Warren Buffett, but it will hold very dearly for most of your clients. And this is even more true where clients have trusted you blindfoldedly that I am in good hands. Then the responsibility of a wealth manager goes up that much more. So please, ladies and gentlemen, please keep this in mind that when you're taking the responsibility of managing money, the entire responsibility is yours. You cannot go back and tell him, guess what, sir? The market fell and hence your money today is negative. I did not expect the market to fall, but it is not in my hand. That time, the client is near about gone. So keep this in mind that putting a process in place, making the client understand the process and making the client understand what you're doing will hold you in good stead, because this profession is not earning a one-time commission. It is not getting a big check today and seeing it going out after few months or after a year. It is about building this big business brick by brick over time, because as I told you, a wealth manager's income is an annuity income. What does that mean? Which means that if I am managing 100 rupees, 1% of that 100 rupees comes to me. I have a earning as per the percent, I have a fixed percentage on that asset under management that I have. Now, if that asset keeps growing, my percentage figure, while being percentage remaining same, the absolute figure, my income will also keep growing. And as long as the clients are of the opinion and they get a feeling that we are in safe hands, he will not look anywhere else. The clients only get jittery when they think that something is not sounding or looking right. So please be very, very clear about this fact that how you are positioning yourself and how transparent you are. Just now, Dilip asked a very important question to Sujoy, and let me bring this up again. The question was this, that in a fixed income market, what Sujoy was mentioning, that in a fixed income market, I am getting 8%, and another company is giving me 10%. One company, if I lend it to that company, how do I lend it? The company issues bonds, I buy it. Or what does the company give me? Company give me an interest out of it. So company A is giving me a return on their buying their bonds of 7%. Another company is giving me a return on buying the bonds of 9%. If I am just an advisor who's just trying to show a higher return product to a client to get his money, what will I do? I won't even disclose there's a 7%. I will straight go and say, guess what, sir? Your fixed deposit today is giving you 6%. Post tax, it's probably at 3.5 or 4%. And here I'm giving you a bond of 9%. And in the post indexation, after 3 years, guess what? You will be at maybe around 7.5. I've done a great job. Client is very happy. Client gives me the money. After 1 year, the company defaults. Friends, it is upon us, or it is the owners of the advisor to understand what risk you are assuming. A company which is giving 9% over a same company which is giving 7% inherently means that the company is having higher credit risk. What is a higher credit risk? That means the chances of a default of company not being able to match its payment obligation is higher than a guy giving 7%. That's why the company has to pay more, because he understands that there is an inherent risk in my profile for which I have to pay more to get money. Now, when Dilip asked that some companies are today saying that, guess what, some of the rating agencies did not rate few companies correctly. As a result, please don't trust any rating agencies, and hence we are also not rated. It is akin to saying, or it is similar to saying that you got an upset stomach when you went to a five-star hotel, and as a result, do not trust these five-star hotels. Start eating street food, you will be very healthy. Ratings at least give us a sense that some third party has looked into their financials. Otherwise, I am just going by what that company is telling me, and I have no way to verify it. Why am I saying all these things? These are the mechanisms by which we have seen time and again some of the biggest relationships slip out of wealth managers. You see how this trend changes, that some wealth manager who was at a point, you may have met some of them yourself, was doing extremely come a difficult phase in the economy, be it financial crisis, be it demonetization time, be it last year COVID time, you will see the entire scenario change. some of the managers are out of business. Why does this happen? And why does this happen in so much of regularity? And yet we are not taking a lesson out of it. This happens because most of the wealth managers are in a rush to make a quick sale or make some quick money by pushing some investment on a client or an investor who may not be aware of what he's buying. He's just going by what you're saying. He doesn't even know what are the checks and balances required evaluating something, because that is principally your job. So a wealth manager's wrong decision, friends will see a fortune then on the street. And hence, there's a huge responsibility, and while it is a matter of rejoice when I am getting clients or when clients are trusting me, but I'm also conscious of the responsibilities that is I'm holding, because their family is dependent on my handling their money, and never ever lose sight of that. So coming to this point, not losing money for your client will only happen when when you express all the risk and nitty-gritties of the way your portfolio composition is happening, and make sure that it's very transparently expressed to the client. Not come to this fear that if I show this risk, and this is a fundamental fear of most wealth managers I've come across. People have even come to me for that kind of an advice. Sir, if say that equity occasion when it can show return, this guy may not put in equity. You mentioned he seems to be very comfortable to declare in high, but how will you endow him, because you don't know what future holds in next 1 year, and you are responsible to the client for the entire journey. At times the wealth pass from to his son to his grandson, and a successful manager will help in the transition. If you have taken a of I am going insured because he's seemingly seem to be comfortable with this idea of putting money, let me just go ahead and push it through, because otherwise he may change his mind. Trust me, it will come and bite you back at some point. And that is the reason so always my thing, or is my proposition, is my strategy, is my entire offering tuned for the favor of the client, or it is more tuned favor of myself. Today I get mails from investors asking me that Vikram, ABCD people have asked me for this. I am getting some messages. Some people are getting a problem connecting to the
It was
network.
break. Your voice was breaking a little bit.
Now is it okay?
Now I
Hello.
think it's okay. I think it's okay
So,
now.
okay. So the point that I'm trying to make here is that please understand the responsibility that comes along when you're getting into this profession, and never rush into taking money from investors before you the just better, or rather more, the stronger your positioning is for with the client in the whole cycle. And you're not there to earn only for 1 year or 2 year. Again, I'm harping, it's an annuity income. You're there, your income should be happening for many years to come, and that will only come when you manage the good and bad times together. So coming to the content that we will be discussing today, while these may not be the core activity for some of the wealth managers, but yes, today these activities are gaining prominence. When I say treasury, what is happening today is, and friends, you would be knowing it better than I, that some of the small to medium companies cannot have a full-fledged finance department or finance team or even a CFO to manage their capital. As a result of which, some of the operations are getting offloaded to independent wealth managers as well. You being from a discipline of chartered accountants, you are actually better positioned than the general wealth manager in terms of handling some of this, especially on the treasury side. I would not get into the nitty-gritties or technicalities of treasury management. The understanding is very simple, that most cases, and I'm saying that it does not include everything, in most cases, it will involve, because when we are talking about treasury, mostly we are referring to corporates here, it will involve a fairly large amount of money that you manage, that is there lying in the company accounts unutilized for a certain period of time. Now that period of time can be a 1 day, can be a 1 month, can be a 1 year, or whatever. So they would like to increase efficiency in this capital allocation. I mean, and for an individual, it can be 1, 2, 5, 10, 15, 20 crore. For a corporate, it can be 200, 300, 500,000 crores also. So how do we ensure that at any point in time, the money is actually not lying idle? When I say lying idle, what I mean that it is not generating any kind of a return. What are the mechanics of that to use that kind of a float in certain way that it generates some kind of a return over and above a zero return, which will otherwise be the case when you have it in a current account. Now, there are various options. We have just randomly put in one overnight fund option, etc., etc. But just to give you an idea how this treasury works, this is how typically it would work. Now, I want to extend this in HNIs or individual families as well. When you become, for instance, I position myself that I am the family's CFO. I am the family's chief financial officer, which means if I can project myself, or in terms of my capability and honesty, ultimately everything will go via me in terms of the family's cash flow generation and cash deployment. What I mean by that is, today, if you are managing some families where I know exactly how much money is lying in their savings account, to exactly how much money is lying in their current account, how much money is there in the fixed deposit, how much money is lying in mutual fund, how much in stocks, how much in everything. Because I have literally taken over their personal treasury operation as a CFO. And this again will come into the play when you have the competence to understand how to do this. Sujoy mentioned a lot of factors in terms of what are the things that you need to build. And these I'm talking about the technical competence in terms of how to manage float. Suppose some investor, let me give you an example, and suppose some investor sold a company. He was earlier a promoter, he sold that company, and he suddenly gets $100 million, which gets remitted to him. $100 million is literally around 700 crore plus, which is holding. Even 1 day delay in deploying the fund in a safe debt instrument is a significant amount of money. So as the corpus grows for any investor, he becomes a quasi-corporate investor in the wealth management space. Because why is it that we need to do this for a corporate treasury? Because what is the difference? The difference is the quantity of capital or the amount of money that you're managing is significantly higher than what a normal individual will manage. Hence, every day return on that money is also meaningfully higher. And this will apply to some of the ultra HNIs whenever it comes into play. So your understanding of which are the places that where we can deploy such that it can be used in the most optimum manner is a skill which will require these treasury operations to come into play. And again, I'm saying that I had earlier told you this one principle that I am more scared of debt than I'm scared of equity. Because in my opinion, a lot of debt in India does not have suitable disclosures for us to understand whether it's safe or not. Equity, I can inculcate or I can encounter a temporary loss. The temporary loss can be of 1 year, 2 year, or whatever. But over a period of 5 years plus, in most of the cases, if not all cases, I would have got my principal back and started making return on it. But if in a debt instrument, and especially when you're dealing with such money, which are large quantity, if there is an issue in terms of be credit quality, in terms of be default arising of low poor credit, you have to literally write off that amount. So your understanding of which debt instrument to use, especially when I'm just using the money for few days, at times just for 1 day, at times just for 3 days, that understanding is of paramount importance. If I'm using money for 3 days, am I subjecting that money for the external risk of credit, interest rate? What are the typically risks that a fixed income instrument will encounter? The broad risk are the interest rate risk and the credit risk. How is the interest rate? How does interest rate impact a fixed income instrument? If my maturity of that underlying paper is very huge, or as in it has a maturity of 8, 9, 10 years, an interest rate movement will impact it the most. If these maturity papers are very less, at times overnight, at times less than a month, at times few days, the interest rate movement will impact it the least. Hence, if you see, we have use the overnight fund option. Why overnight fund option? Because if it's overnight, at least one risk that we are more or less saving ourselves from is the interest rate risk. So these competent or these understanding of which tenure to use for what kind of funds is very important when you're using debt as an investment option. So when you're doing your asset allocation, when you're taking an asset allocation on the debt part, and I told you this also, and Sujoy brought it up very clearly in his presentation, that be extremely careful of chasing higher return in debt, because that is the idea why you have kept in debt. Because if you have to chase higher return, you might as well do it through equity given a certain time frame. So to bring this point out, the treasury management, while it can be applicable to corporates, managing how you're managing their money on a day-to-day basis, giving them the maximum or the safest return on a certain period of time, the same treasury principle will be applicable to most individuals whose corporate is significantly large. And that is one of the things that today most of the larger families where we are creating family offices for them is asking for, that you manage the entire float for us, and we are talking in excess of 100 crores. And there are various family members. Some are running independent businesses, some are running have their corporate lives. So you are the central person managing the entire cash flow for the family, and your understanding your systems and your processes should be bang on so that you can incorporate all these together. So, friends, this is the point that we wanted to highlight to you. The next thing, and I will let Dilip address this. Before Dilip comes in, I want to just put in one point. NRIs or non-resident Indians always have been seen as one of the very crucial, you can call it lucrative, or you can call it very prominent base for wealth advisors. You would know there is a huge amount which was transferred from NRIs to India in the last 1 year during the COVID, and probably one of the all-time highest figures. Now, there are instruments and there are constraints as well for what NRIs can do, what NRIs cannot do. So I would ask Dilip to address this. Dilip?
Yes, Vikram. Okay. Just before we get into this, Vikram, one
Yeah.
gentleman had sent not a query, it's a comment, I think, rather. It
Huh.
says, it is not fair to paint all advisors with the same brush of pushing products. I'm saying that we are also advisors,
Yeah.
but
I think it's a very good point. Uh, Absolutely correct that it is not that every advisor is today pushing product. In fact, I would say the smartest of advisors don't push products. If you're smart enough to understand what makes your business tick in the long term, then definitely you would not be pushing product, because you know for a fact that today investors themselves are extremely savvy themselves to understand when a product is getting pushed, even when it does not have any merit. So I completely agree. And the idea was not to say that most advisors are doing it. Most advisors, it's not that all advisors are doing it. In fact, today I think the smarter lot of the advisors have understood that how to create a much more, I would say, long-term business model for wealth advisors, and as a result, push the process, not the product. If the process is right and that gets accepted by the client, mapping the product is relatively easy and relatively safe also, if the process is right. So I would say let the advisors more emphasize on the process than the product. Product should come right at the end, but the process is what is most important. I mean, we take pride. I personally take pride that, and I give it out in the open that in case whatever I'm telling you that you buy, put in A, B, C, D, E money. In case you see that something is there which is better than what I'm telling you, please come and highlight it to me. As long as it fits into my risk return criteria, I will certainly adopt it, because I have to ensure the best is always with me and my investors get the best. So I clearly take that point that it is not the case that all advisors are doing it. In fact, today the trend is slowly, because this realization is slowly coming in, that if I have to get long-term money for from my investors and make my business long-term viable, I need to ensure that I do not push products, because too many people have in the past pushed products in various forms. And I'm not just talking wealth advisors, there are insurance people, there are bankers, there are etc. etc. So in each category, there are exceptions. In each, I know some people are genuinely good insurance advisors. I know people in banks who are genuinely thinking of the investors when they are putting out, banking services. And similarly, there are genuinely good wealth advisors. I was mainly talking about what are the principles you should follow, and not following it, what are the pitfalls you will encounter going ahead. So that's what. So Dilip, any other question which has come up, or this was the only one?
this is all.
Okay, fine.
Yes.
So I think you can start off.
Yeah, okay. I'll continue on. Okay. If we look at what Sujoy was mentioning about India going towards a 5 trillion dollar economy, it generates a lot of business and a lot of money in India. And there are also a lot of NRIs who we all know that who've been making a lot of money outside when there are a lot of IT people, manufacturing, and in any field, there are people. One thing we also observe, and we want to share this with you, of course, as chartered accountants, I know so many people who have gone outside India are in touch with the CA in India for the tax filing and advice or anything else, even for investments. So it's something which is very important. Of course, you know it. We are just consciously highlighting because which are the focus areas, where people are looking for guidance for investments. One is NRIs. Okay, NRIs, again, this is it varies from different profession, different kinds of different countries. Okay, so we have clients from Malaysia, Singapore, Indonesia, Europe, USA, UK. So there are clients all over. So one thing is that it's very important for us to also give them the correct picture and say what are the areas of investments and where which are the things which they can look at. Okay, and there are many schemes available which where NRIs can invest. See, they have most of the options available. Of course, if they are investing in direct stocks, it is through a PIS, bank account, PIS. As far as mutual funds are concerned, there are most mutual funds have option of NRIs to invest, and there are a few where NRIs cannot invest. So one has to look at these things and then filter. Then, of course, like Vikram, I'm not getting into quality of advice because I'm not a wealth manager per se, which where Vikram is, and so I'm saying that we are looking at people who seek guidance and who look for. So one thing we observe is that one of the client target segment, NRIs are a big client target segment. In fact, I happened to meet one gentleman who was a client of where I used to work earlier. I met him in a different country. I met him in Indonesia. Then he told that, in fact, he said, I am staying in a project where there are at least 25 NRIs, HNIs. He said, you should address all of them together. He said, I will organize. Of course, now it's virtual and like we meet here. So one thing is that, so we try to connect with one person, then address the other people, introduce and talk about India, the opportunity in India, where they can participate. Because the person who's living abroad, okay, there are, of course, there are OCIs who were born outside the country and they have taken an OCA card, or NRIs who later on took citizenship outside the country. But people who went from here recently in the last 5 to 10 years will still know much more about India than there are OCIs. I have friends who've been who was born in a different country, whose parents were in India. So they are OCIs, and they were born and brought up outside India, but they have an affinity towards India. They keep coming to India. So we also talk to them about, they want to know more about it. So like I said, chartered accountants will have clients who are overseas. So I'm saying that is another area where, we can look at. And if we look at money movement, of course, the even see if they invest from NRE account, what is coming through NRE account can go back to NRE account. Okay. Apart from that, you have a $1 million per annum, which can be remitted overseas. Again, there are some people who bring in money, say $500,000 or $1 million to invest in a particular real estate project. And if they declare it to RBI, when they sell the property, what money they brought in, they can take it out in addition to that, this $1 million is available. So it is also important. And of course, as CAs, you would know these things even better than I would. So, what one needs to also look at is look at these except they cannot buy agricultural land, while they can inherit agricultural land, or if they were owning it. So there are a lot of queries. So it is also very important. And of course, chartered accountancy course includes a lot on FEMA, and there is an expertise for CAs on that, which is very essential for this, because we need to know whether they can own land in India, or they can sell, how much they can take out, how much can they. So most people ask, if I bring in, if I want, suddenly I want to take money out, can I do it? Okay, so unless and until this exceeds this money, and of course this is $1 million per individual. So if the husband and wife bring $1 million each and invest here, they can take $2 million outside the country. Seldom there is a need, suddenly they will require more than that. This is again per financial year. So you can take out literally $1 million in March, and $1 million in April. So it all depends, it spans out. So I think there is a good opportunity. And this is something where the environment is quite friendly for non-resident Indians, and we need to look at this also segment and address. Like I said, the concern I have found from NRIs is that the first question, even Vikram was talking to a gentleman today outside the country, right? Vikram, so his concern is, he's asked, he says, I want to take, whenever I want to take my money out, I should be able to do it. So we should say, we should know this, how much he can take out, and then so in which are the kind of, so then the options. So um, so that India is it's happening. Things are happening in India. I think the people should be given. They should be made aware of the opportunities. Okay, so this is something which I would like to add and say on this topic. Vikram, any other points you have?
Yes, I actually see some questions which have come up. A couple of them, which let me try and address in whatever way and manner I can.
Yeah.
First, of course, how to analyze mutual fund schemes, or how to analyze share market through technical analysis, trade in options, day trading, etc. Okay, first of all, I don't think it would be right for me to explain or teach you how to analyze. I think, which is why this requirement of yours to go through a proper designated course to understand this whole thing. I cannot just give you an offhand answer to that. There are various mechanisms by which a mutual fund gets analyzed, not just only through technical parameters. And in fact, the same thing. Oh, there's another question. Okay, so all this literature of what is the way to analyze mutual funds, how to analyze a stock, how to do a technical analysis, what is day trading, what is trading options, all these aspects will be covered in probably in one of a take one in-depth course in this for you to understand. I'll just briefly mention some of the things that I look at, and this is no way saying that this is exhaustive and this is the only things to be done. Typically, I do not differentiate between a, a fund given the structure. What I mean by that is, I had told you last time in last two sessions that four aspects that we look at: risk, return, tax, and liquidity. As long as these four factors, just now Dilip mentioned that most of the NRI people would be asking you, is the money which I've invested can be redeemed at at will. So one thing that I look at when I'm looking at any fund is that first option in liquidity. Is there a problem in liquidity, or has this fund ever encountered any liquidity issue in the past? I told you also this one thing that why for debt, I like bank franchise mutual funds because I think they have an overnight funding option, which is obviously not very clearly disclosed in writing, as we saw happening during in the worst of crisis period. The other point that I look at is I typically look at how are the funds doing when things are really bad. Today, when I see market return from different product providers, be it mutual fund, be it PMSs, be it independent advisors managing portfolio, even investors coming and telling me that, Vikram, I have a 15 stock portfolio or 30 stock portfolio. So my way to look at or analyze this is that first point I tell people, investors, is don't be lenient towards a portfolio which, especially this applies to stock portfolio, which you have created yourself. Use the same parameter which you will be using to analyze a fund and the same parameter which you will be using to analyze your own portfolio and put them against the best performing fund. Now, the question is, what is best performing fund? Does that only mean the highest generating fund as we speak today? The answer, in my opinion, again, I'm saying these are the things that I follow. Somebody can have a different process. I'm just giving you an example to bring this point out. As far as I'm concerned, I want to see two things. I want to see that when things are really bad, and I had a great example of last year, March to May. I told you that the market and a total return index of the large cap index was down around 26% 1 year return ending March 31st of last year. So March to May, I want to see how these funds have performed. So it gives me an idea that when things go bad, how bad can it be for this particular fund that I'm looking at? If I see that somehow in the time when things are really bad, they've been at least able to protect capital, that's a huge plus for me. I will literally assign a 20 to 30% weightage to that indication. Subsequently, there can be other things also that as the market picks up, how many of them have picked up equally or more. And accordingly, I will keep that model gets built up in terms of what is the weightage I give to each of these parameters. There are technical ratios, Sharpe ratios, Trainer ratio, up capture, down capture, all of that is there. And it's full of that in the internet. You will look up and you will get many examples of that. I am just telling you what are the qualitative measures that I look at, which give me a comfort. And secondly, I look at that underlying fund manager, what is his credential in terms of managing different funds. That becomes all the more true when you're looking at mutual funds. Is this outperformance a very recent outperformance, or has he been doing it across different funds? Because I am trying to, especially for equity, I'm trying to position it as a manner that it does not get disturbed for the next 3 to 5 years, and the investor does not need to break his head, am I in the right fund or not? So this is what I would say that are the things that I would look at when when I'm trying to assess different kind of a product, be it in the mutual fund space, be it in the space of PMS or any portfolio. And I keep telling people, many a times you will encounter this, friends, that the gentleman or the investor will tell you that, guess what, I don't need you guys because I've been doing extremely well managing my own portfolio and I have a portfolio of stocks. Try and avoid to get into the fact of telling him that why his thing has not done well. Rather, you bring him on your side, telling him that both of you are trying to figure out the best for the capital. And that's why we had one of the line in our presentation saying that we want to be the ruthlessly honest to capital, not even to the holder of the capital. What I mean by that is, if I think something is right for that capital, I should have the courage to tell him that you are doing something wrong because this is where it will get impacted. If, and I have seen this also at times, some wealth managers do it. If somebody says that I only want to invest in real estate, they start scouting for real estate for that wealth manager, for that investor. If they see I only want to invest in fixed deposit or fixed income product, they start scouting for what would be the best fixed income product for him. What I'm trying to tell you is that if you can get the client to buy in your knowledge of way you manage the whole portfolio, which may not necessarily to what he had started with, you have a far bigger chunk of asset to manage. Otherwise, you're just a glorified runner boy trying to get him something that he wants. First, you have to be in a position like when you go to a doctor, you do not tell the doctor, sir, I have a stomach ache and hence I think there is some ulcer. Please give me the right medicine for that ulcer. It's not that the doctor is going around finding the right medicine. He will tell you whether that stomach problem is an indigestion or an ulcer or whatever. So try and assume the position of a wealth of a doctor than being a compounder who's just supposed to get the medicine for him. So the point I'm trying to make here is that do not go by what the investor is telling you. Go by what the capital is telling you, which he is holding. And that is what the investor is actually looking from you. And same thing, like you go to a doctor not to tell him of your disease. At best, you will tell the symptom. The actual disease, the doctor is going to tell you. So that is how you should position yourself. I have one more question here, that is the same principle applicable to mutual fund managers? Are they so committed as wealth managers, desired characteristic which you just mentioned? See, today in the mutual fund industry also, a lot of new regulations are coming into the marketplace, mostly being governed under SEBI. Today, some regulations suggest that whichever fund that the mutual fund manager is managing, part of his net worth has to be invested in that same fund. The idea here is that if the mutual fund manager thinks he's doing the right thing for his investors, why is he not putting his own money in that scheme? Now, whether the same principle applicable to fund managers or wealth managers, I think, in my opinion, yes. The principle of putting the investor first, that principle applies uniformly across all money managers. Whether it is a wealth manager managing it through via some instruments or whether that instrument manufacturer who's managing money. So that principle I feel is an universal principle or universal quality which is required. Do all of them follow? Answer may not be yes. Is it that the regulation is more directed towards making them follow it? The answer is yes. Certainly the regulations are following it. There are practical challenges to certain regulation. Now, if I am managing a liquid fund and I am told that to please put 20% of your net worth in liquid fund, which is a debt fund, which is supposed to be held for a shorter period of time, and yet I am being forced to do it because I am the manager of liquid fund, that may not be the right. So there are exceptions to it, but to answer your questions, the same principle applicable, in my opinion, yes. There's another statement that I see which has come that when you are it is negative return rather than zero return. I think the gentleman or the lady is referring to the return, but I'm talking when you are sitting in front of the investor. It is a return which will be compared against at times a benchmark. If the Nifty index have given certain return and you are way below that, maybe you are answerable why. If and yes, whether the index is down or up, if there is a negative return, certainly that is not liked by the client. So to answer your question, zero and negative, zero would somehow save it because it's still not red, but anything red would certainly draw attention, and you better have an explanation to that. Is
Okay. Vikram, the other question is how to.
Yeah, there's some question on the NRI side. Can you see it, Dilip?
Yeah, see, now that's I've got to clarify how to advise care HNIs to invest in global equity.
Okay. There is a lot more question now coming up, I can see.
As usual,
Global equity.
your popularity.
No. I think it's just that these are the things that we get
Yeah,
faced
yeah,
with every day.
yeah, yeah.
I think the global equity part, today, thankfully, there are a lot of funds which are having global instruments. Now, when I say global instruments, till now, this I think we had briefly touched upon in my last session, that till now, most of the global funds were very aligned towards US. Why? Of course, the market capitalization in US is the highest, the GDP in US is the highest, and as a result, it was very. If you talk about a global fund, you would have maybe a couple of months or year back, you would have seen 70, 80, or 90% mostly US stocks or US instruments for that matter. I think over time, there are instruments which are coming up, which is not just US centric, but it is global in the nature. You will have European component, you will have Asian component, you will have Asia X Japan component. So different kind of funds and alongside different kind of schemes are coming up. But please understand one thing very clearly, and this is something that for which you need this expertise. When you're buying a global fund, whether it is through a global PMS or global mutual fund, whatever manner you're buying, there are one additional risk that you're incurring, which most of you would know. That risk is the currency risk. As you would know, in the last, typically what was the mentality and what was the thought? I wouldn't say mentality. The thought of putting in the global asset was this, that you're deleveraging your investment from just being at the mercy of one economy, and you're diversifying across the global names. Some of the large caps in globally would make Indian large cap look like mid cap compared to say an Apple or a Amazon or a Microsoft. So a lot of people will say that actually I want to partake or want to participate in those biggest of global large caps which are there. Why am I only stuck to a Reliance or a ONGC or a Infosys here? So for which this demand was there, and as it is with the demand, the products also started coming forward. But what you need to understand is, along with that asset, you are also taking currency risk. And dollar in the last few years has not been the best performing currency and has depreciated in some of the other hard currencies. While it can reverse and it should reverse going ahead, but I'm saying that again, when you're bringing this out to the investors, make sure you tell them that this risk is there. Secondly, why is it that in India we were very keen to have a dollar denominated asset? Because of the fact that India's currency over a 8-10 year period would depreciate against a dollar, and as a result of which, along with the underlying asset performance, you got a tailwind or you got an advantage of rupee depreciating against the dollar because your investment was in dollar. So when you're redeeming back in rupee, you are getting a little bit more because of the dollar movement. Coming to the point, now somebody can question that why is it that this is taken for granted that Indian currency will always depreciate against the dollar over a 5-10 year period? What is it that makes a currency? What is it that determines an exchange rate? One of the key components of determining exchange rate in the long run is inflation. If you see a US inflation would less than be 1/3 or 1/4 of what Indian inflation would be. Given the fact that we are in an inflationary territory as far as our country is concerned, given our growth potential and all the demand potential that we typically people talk of. So the thought was that with inflation being there over the next 10, 15, 20 years, which will be significantly higher than the developed world and mostly US, it is most likely that the dollar will depreciate, will appreciate against the currency. Hence, my dollar denominated investment, apart from the asset doing so well, my currency will, the conversion will also help me, say 2, 3, 4% every year. So that was also an idea which was put into place. To be noted that that idea or that notion to some extent got challenged in the last year or so. As US was approaching the election, dollar started taking a slump, and today with so many other things coming to face, there is a view coming out dollar may not be the exact reserve currency as people used to think about. So there are a lot of views floating around it. But my point is that please be yourself aware of this factor and convey this factor when you're putting out a global product recommendation to your clients. There's a one long statement. Okay, I think Sujoy, you are there?
Yes, I'm there.
This is, I think, more. Yeah, this is a question. This has come to me.
What's the question?
The whole of this course is subjective and theoretical in nature. How and where can I get practical knowledge and exposure in the area of expertise as I am keenly interested to get into this field? Thus, would appreciate if I am given some insight pointer where I can get the practical knowledge or exposure to learn this in whole. I think what he's meaning that whatever you mentioned was sounding little theoretical. Does this include practical exposure to real clients, real this thing which this gentleman is looking for?
Or he is
And do you
asking
teach any
like,
other course like this?
yeah. So yes, so if somebody wants to get into this field, obviously what we are suggesting is that going through a course which is designed to prepare one to get into this program. One is to look around, and there would be courses in the market. So one needs to look around and identify the one which is relevant. I don't think we are prepared to spell out names over here on this forum. But yes, there would be programs available.
But does the course that you are conducting, does it have practical exposure and client interaction opportunities?
Absolutely. So we feel that this program that we are designing is suitable, which addresses all the key faculty areas. One is the theoretical part, then there is the practical aspects, client interaction and everything, the market interactions, and the direct interaction with industry participants as well.
Okay, thank you.
One question to Sujoy I see is that how is your course different from chartered wealth management? I don't know chartered. Is it CFP? He refers to CFP or?
I do not understand that.
Yeah, it's the question is how is your course different from chartered wealth management? So I
Okay.
I'll skip that.
Yeah.
Okay. There is one question which has come up. Can CA do wealth management without being SEBI registered advisor? NISM XA exam.
I'll take
Philip, you would want to answer this?
Yeah. Okay, so basically, to be a distributor, you should be AMFI, get a ARN number, register with AMFI, for which you need to clear the distributor module of NISM. I am told that it's a 1 hour exam, I think, or I don't remember. I took it last year. So I'm saying it's available online. So there is a difference in under SEBI, which is a distributor and advisor. So if you're an advisor, then you fall under the SEBI investment advisor regulations. 2013. Okay. According in that, of course, there you need to, if you're an individual or a company, you need to have requisite qualifications and experience and all that. So, that's something you go through the IA regulations and take a RIA license, that is a registered investment advisor, that's there. But to be a distributor, it is only NISM exam pass. Then you're not coming under SEBI in that sense. You are an intermediary, but as I said in my earlier talk last week, also that for being a distributor, you're not directly under the SEBI thing. It is SEBI, then under SEBI, then the Mutual Funds Association, AMFI, then you are, of course, AMFI also keeps SEBI guidelines in mind while forming the rules, what you need to follow. So it's there is a declaration they take from the distributors every year, but it's pretty much simpler than being an advisor. There, by being a distributor, now what does it entail? You can advise the clients on the mutual funds or schemes or other financial instruments you are referring to the client, but you cannot charge a fee for the advice. Okay, so basically you cannot charge a fees without because you're getting commission. So that's the thing about SEBI. I hope that's clarified.
Now, there's one question which has come up. Events like Franklin Templeton have reduced the faith of investors in mutual funds. Furthermore, the mutual funds do not beat the index, even though it is pure equity fund. So I think the person asking this is basically saying that why should we consider a mutual fund given the past experience has not been particularly great. So this is my take on this particular subject. One, of course, is that any financial asset, whoever is managing, whether it is under a mutual fund, whether it's under a PMS or any financial asset, would have its own risks. And it is the job of an advisor to understand the risk and advise accordingly. Equity will typically have a risk of volatility, and debt will have its risk of either credit or interest rates. Now, to extend this discussion that what happened with one mutual fund necessarily needs to hold true for other itself, I think is wrong. In that way, we would have similar risks emanating from every broad institution, starting from a bank to any institution, financial institution that you think of, who's managing financial asset inherently is managing certain amount of risk. It is for us as advisor to try and sense that beforehand and put caution to the investors accordingly. Coming to the point that index funds most of the mutual funds have not been able to beat index funds, and hence why do we even bother looking at actively managed fund? I think we had addressed this question in the last session as well. Given the fact that the market has in the last few years have been very narrowly moving, given the, even if I look at that Nifty 50 index, which is a 50 stock index, if you see the movement, it is typically been moving over a 5 to 10 stocks. And that is what has moved the index from whatever level in the last 4 to 5 years. Inherently, a mutual fund is going to underperform a narrowly moving market. Why? Because a mutual fund, by the guideline of SEBI, cannot have a portfolio only comprising of 10 to 12 stocks, because then they will compulsorily bring in a concentration risk of each stock. Given that mutual funds have to comply to that SEBI's dictum of number of stocks being that many more, many a times would happen, there will be a phases in that equity journey where you will see that there are certain time when broader mutual funds would be underperforming the market, especially in a time like last few years where it's been moving across in just few sectors or maybe very few select companies. My opinion, and this is just my opinion, my experience and opinions is that whenever I look at a crisis period, the way what we have seen through in the last 1 year, and what if I can draw parallels from that, starting from 2008 time of financial crisis, demonetization time, maybe more so when it's a global crisis. Post that, we see a far more widespread performance across categories for each of different sectors, because the government measure starts to get into some of these sectors which have been otherwise ignored for long, because they want to revive the company revive the sectors and the economy post the crisis. Hence the effort and the help provided is that much more concentrated. That is the reason I feel that going ahead, you might see a far more broad-based movement compared to what we have seen in the last few years. As market becomes broad-based, you will see the actively managed fund probably starting to beat the index on a whole. So this would be my view on this particular thing. I think is there any is last question I'm going to, I think for today, it's already 8:15, I'm going to take, is there any reason that index mutual funds are better than index ETFs? First of all, please understand the difference between the two, index funds and ETFs. Index funds, just like a mutual fund, is comprised of stocks which is trying to mirror the index. When you're buying an index fund, you are basically getting the same units of mutual fund as you will be getting in any other mutual fund that you buy. Index ETFs, on the other hand, are a basket of stocks which are given to you in a certain proportion that you're buying. Automatically, some of the advantages of a mutual fund, be it in terms of SIP or these operational advantages, comes into the fore. I personally think that anybody who's trying to buy the index would be probably better off doing it through a mutual fund if you're not very competent on the direct stock market yourself, and then taking the ETF route. But essentially, they are more or less trying to track or do the same thing. It's just that one is doing it directly through stocks and one is doing through a fund route. This is, I think, where we will end this. I think this also more or less takes
There's
care of
one more
all.
question.
Yeah, Khushbu, is there anything else?
Yeah, just a second.
Okay,
It's the
let
same.
this be the last question and then we'll call it a
Yeah,
day. And
it's last only.
Okay.
Is the same principle applicable to mutual funds manager? Are they so committed as wealth manager
No, I think
desire?
we addressed this question, Khushbu.
This is
And
already addressed.
yeah, we have already addressed this question. So I think we will call it a day today for today's session. And thank you so much, friends, for patiently hearing all of us out. And definitely look forward to interacting with you tomorrow again. Over to you.
Thank you. We had a fabulous session. I think everyone enlightened from various issues, including treasury, NRIs investment, and how one can become a successful wealth manager from Mr. Ghosh. So now I request over to Divya. Please conclude.
Thank you, sir. Thank you. Members, on behalf of Managing Committee of Bangalore Branch, I take this occurrence to propose formal vote of thanks for third days of workshop on wealth management. I wholeheartedly thank Mr. Vikram Sengupta, Ms. Khushbu Sethia, Mr. Dilip Balakrishnan, Mr. Sujoydas for an excellent presentation and enriching all of us with so much of knowledge and updates. Thank you so much, sirs, all of you. On behalf of all the participants and behalf of entire Managing Committee of Bangalore Branch for spending all of your valuable time and making this a very knowledgeable session. Thank you so much, all of you.
Thank you.
Thank you.
Good night. Good night.
I also thank all the participants for your active participation. We shall meet in the next session. Thank you so much.
Tomorrow 6 p.m.
Yes,
Yes.
thank you, sir. Thank you so much.
Thank you.
Bye.